Do you ever ask yourself, what's the point of saving and investing? The answer is we all need a pot of money to live on when we stop working and retire. But that pot has to be big because of the nasty effect of inflation, which burns the value of our money at an alarming rate. Inflation, or rising prices, has been with us a long time. Government data goes back to the 18th century. Between 1750 and 2003, the prices of goods and services rose by around 140 times. But most of the increase has come in modern times. Inflation is important because over time it reduces the purchasing power of your money. For example, last year it took over £3,300 to buy what would have cost just £100 after the Second World War. If that doesn't hit home, how about it cost £154 last year to buy what only cost £100 in 1997? That's the effect of annual inflation of just 2.9%, by the way. You see, the value of the pound in our pocket is declining all the time, and over a long period, that makes a big difference. A lot of people rightly worry about the impact inflation has on their wages. Obviously, if your pay doesn't keep up with annual inflation, then you're suffering a cut in income in real terms. But the same is true of your savings. If your savings aren't getting a return above inflation, then your pension pot is burning away before you've even retired. This table shows how high in each year your savings had to leap to get a return above inflation. The 1970s were particularly bad. Soaring energy costs after the oil crisis saw inflation average 13% in that decade. Fortunately, more recently, inflation has been much lower, averaging 2.5% in the noughties, but rising to over 4% in the past 3 years. So what can you do about it? For a start, don't leave too much money in cash. Cash is good for rainy day emergency money, but it's useless for saving for your pension. Over the past 10 years, cash returns have fallen just behind the rate of inflation by 0.2% a year. Government bonds, or gilts, produced a 3.4% real return above inflation. Shares, or equities, jumped well clear of the flames of inflation with a 5% real return on average. The picture changes slightly over different time periods. Over 20 years, gilts beat shares. But over 50 years, shares beat gilts again by a mile. That's why experts say if you're saving over decades for your pension, you want to be invested in the stock market, with most of your money in shares, some in bonds, and only a little in cash.